Hello, everyone, and welcome to another live episode of The Yield. Be sure to subscribe to the show on Apple Podcasts, Spotify, or YouTube, and leave a review if you enjoy the content. In case we haven't met before, I'm Peter Kerr. I'm the Director of Product Marketing here at Yieldstreet, and today I'm joined by Ajit Tripathi. Ajit leads institutional growth, strategy, and partnerships at Aave that enables institutions to participate in decentralized finance. Previously, he built banking and payment rails for Binance and Paxful and led the build-out of the UK blockchain business for PwC. Ajit is a crypto co-host of Breaking Bank's Fintech podcast and a columnist for CoinDesk, in addition to being an active angel investor in high-quality crypto startups. Ajit, welcome to the show. Why don't you start off with just telling our audience a little bit more about yourself?
Yeah, thank you, Peter. So I've been in the crypto space for almost 5.5 years now, and before that, I was in capital markets, technology, and change, working across front, middle, and back office for 4 different investment banks. So I have a pretty in-depth background in products, financial products, and technology systems integration, and so on. I'm an engineer by trade, so so DeFi is kind of a natural home. And one of the things that I also did between PwC and Binance is build out the Fintech practice for Consensus, which is the largest Ethereum-focused business in the world. So I think now we see a lot of really interesting things going on in the whole Web3 space that we're going to talk about in the show. That I'm looking forward to speaking about in your show, and it's just something I really enjoy doing. It's great to be on your show.
Yeah, thank you for joining us. So it's interesting. You mentioned you started about 5 years or so ago, which I think most people six-ish. Yeah, I think most people peg crypto sort of starting in the 2007, 2008 period.
2008 is when Bitcoin was white paper came out. Yeah.
What got you started? How come you decided to jump in?
I mean, I could tell you a more interesting story, but I was just bored doing what I was doing at PwC, and it was consulting can be fun, but I think some of the audit parts, are not fun at all. And at that time, fintech was really exciting. There was a lot going on in fintech, and one of this whole blockchain space was seen as an area of fintech, and there was a lot of buzz starting to happen with Blight Masters and a few other people sort of going around and saying, "Hey, this thing is going to disrupt Wall Street. It's going to change how we build financial infrastructure." And then so I mean, and nobody else really wanted to do it because there was no real revenue in it. So I saw sort of a greenfield opportunity, and I thought, okay, if no one wants to do it, and this thing looks really interesting, I'm just going to go do it, right? And then I also did this early in-depth course on Coursera by Arvind Narayanan, who is a professor at Fintech, and so I'm a tech guy. So I'm not going to say things like, I wanted to disrupt banks, or I wanted to, revolutionize Wall Street. None of that. I really thought the technology was incredibly interesting. There were lots of great things that could be built with it, and as an engineer, that's really provoked my fancy. So I found a greenfield opportunity at PwC that no one really wanted to get into. So I got into it, and I took hold of it and ran with it.
So it's funny. I mean, when you think back to kind of that time period that you really got involved, I would say that acceptance was growing, but I think relative to now, crypto is probably much more widely accepted now than it was. What kind of gave you the confidence then, with a lot of naysayers out there to kind of really forge forward?
Yeah, I don't think that's hard. I'm from the 1997, 98 Web2 generation. I mean, if you see an interesting problem and it seems like fun and it seems worth doing, you just go do it. Back in 2000, was this 2015? In fact, everybody thought Bitcoin was for money launderers, and and you couldn't actually have go to a bank and have a sensible conversation about using Bitcoin in a banking environment. So, everybody wanted to talk about blockchain technology, and that too in the context of the private blockchain space, right? DLT was the big thing. So for me, it wasn't so much a matter of confidence. I just thought the technology was truly fascinating, and it was complex. It was you could build systems with blockchain that you couldn't build, trustless systems that you couldn't build without the technology. So it had a very specific niche, and it was just so interesting that I wanted to do it. So it wasn't kind of a strategic decision. No, there is a big future in it, or we are all going to get rich or anything. It was just too interesting to not do.
Yeah, I mean, so for our listeners who maybe are a little bit less experienced, there's obviously crypto, which is a little bit all encompassing, but there's also technology like blockchain that underpins a lot of the cryptocurrencies out there. Then there's this other concept that we're going to spend a lot of time on today, which is DeFi or decentralized finance. Maybe you could kind of start, in a building block sense of kind of explaining crypto, and then also maybe contrasting that versus what the blockchain is.
Yeah. So blockchain technology is essentially a distributed systems technology, right? So, for example, when I run a program on my computer, and it's the only computer that's running that program, then that's not distributed, right? It's just one computer that's running that program. Now, if I run that program, break it into parts and run that software on multiple computers, then that's kind of what you call distributed computing, right? You take a piece of computation problem and then you run it on multiple computers. So there are multiple distributed computing paradigms. One is cloud computing, like Amazon Web Services, that everyone is familiar with. And then there is also, this idea of blockchain, where you rely on consensus, where you rely on multiple computers agreeing on what gets written to a shared database. So what's really cool about this is that you can create systems like Bitcoin or Ethereum, where no one entity, no company or individual controls the system. But then we sort of, in a trustless environment where nobody trusts each other, or doesn't have to trust any particular single entity like a bank or a central bank, you can create this concept of data that cannot be copied. And the genius of Bitcoin is that for the first time, it created a way for a set of computers to agree on a piece of data, and then made it impossible for people to copy that data, right, without being detected. So on the internet, when you send out an email, then anyone can copy that email, but when you actually, no one can copy a Bitcoin, right? Because if you copy a Bitcoin, it's worthless, because the Bitcoin network as a whole doesn't agree on what happened on the transaction. So if I'm getting a little bit complex here, so Bitcoin was the first time that on the internet you could create something that was unique, that was not copyable, that nobody could copy, and therefore it had some kind of value, right? So if you copy a dollar bill, then that copy of a dollar bill has no value. Whereas, if that dollar bill, the only way that dollar bill has value, if you cannot double spend it, i.e., you cannot copy it. So Bitcoin sort of was a fundamental technological change. And the technology it uses underneath it, the set of technologies in combination that Bitcoin uses to make that happen, is called blockchain technology, right? So it's a distributed systems technology that it makes it impossible for people for a piece of data to be uniquely identified and not copied. So now, then in the enterprise space, what people said is, look, we don't need these coins. There is no value in this. We don't need the coin idea. We don't need the monetary token. We're just going to deploy this technology in a corporate environment. Now, that idea was big for a while, but now that idea hasn't really worked. And now what we're seeing is this idea of applications that are deployed on the public internet on blockchain technology outside of any firewalls, right? So not inside any particular company, not controlled by any particular individual. So more and more applications are coming through that are now being deployed on on public blockchains, blockchains that no one controls, blockchains that are not hidden inside a firewall, blockchains that anyone can access, right? So that type of permissionless, you don't need anybody's permission to connect to blockchains technology. That's kind of the dominant technology paradigm right now. So, and to the second part of your question, decentralized finance. So Bitcoin created the concept of, decentralized money, right? Money, a money token or a piece of value that was not issued by a central bank, that was not controlled by a bank, or where you didn't need anybody's permission. You could just start a computer, run Bitcoin software, and suddenly you were on the network and you could transact if you're using a basic wallet. So that was a bit of a revolution. Then Ethereum came along, and Ethereum created this idea that you could not, instead of just creating a simple money token called Bitcoin, you could create really complex programs that did very interesting things, where you could give this piece of money more complex behavior, right? So, for example, when you look at forms of value like stocks have very complex behavior. They have dividends, they have, stocks have cash flows, bonds have different types of cash flows. So with Ethereum, you could create a whole bunch of tokens or different types of applications that made it possible for people to use really sophisticated forms of value. Now, on top of that, using Ethereum technology, a whole new class of applications has been deployed, which we call decentralized finance. And in decentralized finance, you just you don't simply have a token or a simple idea of notion. You build something more complex again. You build applications where you can earn a yield, where you can essentially do trading, where you can do borrowing and lending activity, where you can do really more interesting financial applications. You can build really interesting financial applications in a completely permissionless, decentralized environment, meaning in an environment that no particular individual entity controls and is on the open internet. So this way of building systems which are really not controlled by any particular entity but can be used by anyone is a truly revolutionary idea, and that's why decentralized finance is so big right now.
Going back, one thing you mentioned, you talked both about Bitcoin and then also about Ethereum. And I'm just curious, most people just think about those as being different coins, but their underpinning or the underlying technology is actually substantially different as well. Can you maybe just elaborate on the different type of coins that they're out there and then some of the technologies? And also, to that point, I think a lot of people are viewing Ethereum as the blockchain of the future. Whereas Bitcoin right now might be a little bit more of a data technology relative, but maybe you can expand on that too.
Yeah, I don't think so. I think, so Bitcoin, it was, so even before Bitcoin, there were multiple experiments to try to create internet money, right? So even Mark Andreessen wanted to have a money token on the Netscape browser. Adam Back built something called Hashcash that used the Bitcoin proof of work algorithm. And the proof of work algorithm came from Hashcash to Bitcoin. So there is a whole history of people and cryptographers trying to create internet money on the internet that does not rely on central banks or any particular company or so on. Right now, so Ethereum is a further advancement on Bitcoin. So Bitcoin's proof of work algorithm, the actual underlying mining algorithm, was modified by Ethereum. And Ethereum added this completely clean, separate layer of programming layer. So on Ethereum, on Bitcoin, you can write programs that are very, very simple. On Ethereum, you can write programs that are very, very complex, right? So Ethereum added something new to Bitcoin. So it's the next step. Now, even today, we are seeing new blockchains come around that add further new ideas to Ethereum, right? So if you look at Polkadot, Solana, there are a few other blockchains that are really building more and more interesting things on top of by using some of the ideas that have been in Bitcoin and Ethereum. So the technology continues to grow. Obviously, when people own coins, they get a little bit attached to the coins they own, and so Ethereum holders say, "Oh, Ethereum is the best," and Bitcoin holders say Bitcoin is the best. But when you think about this as a technologist, then each one of these blockchains represents an advancement or progress in the state of blockchain technology. So Ethereum is also evolving. Ethereum is moving from to a different consensus algorithm. Ethereum is scaling. Ethereum is becoming more complex and more sophisticated. So from a technology standpoint, Ethereum adds new features and new capabilities on top of what Bitcoin was able to do. And then other blockchains are doing the same thing on Ethereum. Right now, from a coin perspective, I think people get very attached to the coins they own. And, and that's just the life of crypto.
Well, how do you see all of it playing out, forecasting out 10 years from now? Are there, a few dominant winners in the coin space, or and also obviously in the technology space when we talk about other applications as well? Or do you feel as though, each year, each new cycle, there'll be advancements in the technology and the future, prominent coin is yet to even be developed?
Yeah, so what we have learned about blockchain technology is, right, that it's impossible to design a blockchain that that maximizes security, decentralization, and and user experience. So a transaction throughput, for example. So you have to trade one of these parameters against the other, which means this is Vitalik's famous trilemma. Which means that depending on the applications you're trying to build, you have to trade one thing for the other, right? So you can have a blockchain that's less decentralized, but really fast, like Solana, for example, right now. Or you can have a blockchain that's much more decentralized, like Bitcoin is quite decentralized. Ethereum is now very decentralized, but it does not have as much throughput. So it depends on what you're trying to achieve. So just like databases are a design space, blockchains are also a wide design space where you kind of say, okay, what do I want my blockchain to do? What do I want my blockchain to be used for? Now, Ethereum is the most general purpose blockchain that's out there. And with technologies that have been built like Polygon or now layer 2 solutions that are coming on Ethereum to scale it, there are lots of different things you can do on Ethereum, and Ethereum is always growing as a family of technologies. But at the same time, there has been a lot of innovation in the blockchain space. You have Cosmos, where you can deploy application-specific, blockchains, where you sort of they say this, a blockchain is optimized for this particular application set. You have Polkadot, where you sort of have a common framework for deploying arbitrary complex blockchains. There are also, blockchains that are coming along that are optimized for different things that maximize transaction throughput, reduce the gas fee. So I think depending on what you're trying to do, you can always choose a different blockchain. What we have seen is, the winners so far, if we could point at a winner, yeah, Ethereum is a winner, but it's not the only winner. Ethereum virtual machines, the programming language for Ethereum Solidity and the environment in which you run these programs have kind of been dominant, and almost everyone is ending up adopting that. But that's still very early. So I think, when you think about this in the internet history terms, then I think we are still in, we have got to email. I think current DeFi is more like Hotmail. It's widely used. There are lots of people, it's the first killer app, so on and so forth. But it's still, there are, apart from DeFi and NFTs and some crypto games, there isn't a lot out there that we can point at and say, oh yeah, this Web3, the new internet has arrived in the shape of blockchains. So I think, how do I see the future? I think, we'll see lots of innovation in the underlying tech stack. We will see blockchains that are optimized for different uses. We'll see protocols or technologies that connect all of these blockchains and allow users to sort of interact with all of these in a consistent way. So Aave, for example, our team is building a truly cross-chain protocol. So Aave has been deployed on Ethereum, Polygon. We're deploying on Avalanche, which is another new blockchain, and we're going to deploy on some layer 2s, Solana at some point, and Polkadot. So I think there will be a small number of winners that are optimized for different users, but then people will be able to build blockchains that are specifically, really well suited for what they're trying to do with it.
Very interesting. And I say this half jokingly, but there was one coin, and I know we focused more on coin than I initially intended, but you haven't brought up ticker DOGE. Have you heard of it?
Yeah. In fact, Elon Musk's Doge, absolutely, and Vitalik is now on the foundation too. So Doge is actually surprisingly promising. I watched Doge very, very closely. I mean, I can't comment on the coin. I think the coins are not for me to discuss. but the technology has its uses. It's essentially merged mine with Litecoin, and you can do a lot of cheap transactions on Dogecoin. So Elon might be right about it in terms of using it for payments. Right.
So, one of the things that our audience comes to us a lot about is just around portfolio allocation, and it's my last question on coins, I promise. But without specifying any coins, but thinking about crypto in terms of an investment, how do you view about even including it, if at all, in a portfolio? And then let's spend some time talking about Aave.
Yeah, so I think it would be. Let's say you go back to 1989 or 1990, and you find out that there is something called the internet being built, right? Now you hit 99, and at that time you decide not to buy into it, and you get a chance to invest in and hold a small portion of that multi-trillion-dollar internet economy, and you say no to that. Okay, good for you, whatever. Maybe it's not your risk appetite. Now you come to 96, 97. And the dot-com boom is just starting, and you say, oh, this is not for me, and it's too scary, I don't understand it. I think that's pretty stupid, right? I mean, to be very blunt, to not have any exposure to crypto at this time, when you kind of clearly see applications coming along, so many developers and technologists building some clear users coming along. I think that's a mistake. So almost every portfolio should have some crypto allocation. Because not having exposure to this, literally the new internet that's being built. I mean, think about it this way: if you have 1% allocation to crypto in an endowment portfolio, it could 100x over the next 5-10 years minimum. If you ask me, or you will lose 1%, right? I mean, it's a no-brainer. If there is a no-brainer in the investment world, then I think it's in the crypto. It is having some exposure to crypto.
Oh, very interesting. So maybe you briefly started touching on Aave, but maybe you can kind of just walk through what you all try to achieve, and then we can kind of go into a little bit more about DeFi.
Yeah, so Aave was started by Stani Kulachov, my boss, and the team back in 2017. It's one of the earliest DeFi protocols around. So when most of us didn't really know about DeFi or weren't interested in DeFi, Aave, then called Etherium, was building out a protocol for one of the first protocols in decentralized finance. 4 years later, now we are a family of protocols, a very large community of over 80,000 plus Aave token holders, and probably tens of times that contributors, Discord, Telegram, Twitter followers and members, and so Aave is what we call a DeFi blue chip, in the sense that it's one of the most well-known DeFi protocols. What Aave does is it enables people to it creates a market for liquidity, right? So if you have excess cash, for example, you can deposit cash in the form of stable coins, right? So it's you have to have some crypto form of assets, and you can deposit stable coins or other crypto assets to earn a yield on those assets, right? So, and the yield is paid by borrowers who borrow these assets. So I deposit, you deposit, and I borrow that. So I pay you a yield. So this type of but you don't know me, right? So it's done in a mutualized way, in the sense that you deposit your assets in a pool, other people borrow those assets from a pool against the collateral they post. So it's all over collateralized borrowing, and it's essentially for borrowing they pay a yield that's then passed through to the suppliers of liquidity. So it essentially creates a much more efficient market for liquidity, and that's the core of the protocol. On top of that, I think there are lots of innovations that the community has built. So there is a social media protocol, there is a gaming related protocol. There are lots of people building lots of interesting things on the Aave protocol, because it's kind of this core base layer of DeFi in the sense of a market for liquidity.
Yeah. So you talked earlier. We kind of think about it like in terms of crypto lending, right? As far as your liquidity protocol, could you maybe just kind of walk us through what that sort of looked like? And you mentioned stable coins as well, which I know are an emerging idea or concept for a lot of our listeners. So maybe you can kind of expand on that as well, since I think they're becoming more and more popular and people are starting to use them, but still not as widely well known relative to traditional crypto.
Yeah. So stable coins are crypto assets that are backed by dollars or treasury bonds or other high quality liquid assets. And the most popular stable coins right now are Tether, which is symbol USDT, USDC, which is Circle's uh, stable coin, and then there are others like Paxos, USDP. So these stable coins have the idea that they use the underlying crypto technology, like Ethereum ERC20 tokens typically, and but their main property is that they hold their value. They look to hold their value against the US dollar. So one USDC, for example, typically has give or take the value of $1, right? And whereas crypto assets like Bitcoin and Ethereum have a pretty volatile value, and it goes up and down a lot. So what Aave does is it allows you to, for example, deposit your Bitcoin, right? So you can deposit your Bitcoin in Aave or your Ethereum in Aave, and then you can borrow against that collateral. So all these interactions are, and when I say deposit, then you're not depositing it into a company. You're not giving your Bitcoin to me or to the any Aave team or anything. You're depositing the money in a smart contract that's controlled by token holder voting, right? So the first key idea is you can deposit your assets and earn a yield on those, or you can borrow against the collateral you have deposited and essentially pay a yield to other people who are essentially borrowing these, who are sort of supplying these assets. So, and the third thing there is it's decentralized in the sense that it's not, so the protocol is not controlled by a company or an individual or a set of individuals. It's essentially all the decisions on the protocol are made by a DAO or a smart contract that is controlled by token holder voting. And if you have any questions, please ask. I'm happy to explain further.
Yeah, I'm just curious. I mean, so a lot of people are finding ways to essentially get liquidity from their crypto holdings and also at a cost. And so some people are also lending in many terms to crypto borrowers. How does that kind of look like, and what type of yields are people generally getting?
So this is not the traditional lending type of transaction. It's basically a new type of interaction, and the novelty is that here you're not sort of so you're not depositing money in my account. You're not giving your money to, let's say, a company like BlockFi or one of the other crypto lenders, Celsius or so on. What you're doing is you're depositing your assets in a smart contract, right? And that smart contract is a piece of software that is not running on the Ethereum protocol, and so your counterparty in the sense is a smart contract, right? And that's a fundamentally new idea. Now that smart contract actually represents a pool, and so the assets are pooled, and then other people, if you're depositing into this pool, then other people can borrow from the pool. So and the borrowers will then be charged an interest rate with every Ethereum block per second, and that interest is then allocated proportionately to the people who deposited the assets. So that's a fundamentally new type of interaction. If you really want to think of it in terms of lending, then it's not really lending in any sense of the word. But I think if you really wanted to sort of draw a parallel, then your counterparty in that case is a piece of code. It's a piece of software.
Very interesting. So as you kind of think forward to the next 5 years or so, what are some of the technologies that you think are coming that haven't yet really been introduced yet that get you really excited?
Yeah. So privacy is a big factor. So I think we're seeing a lot of innovation in zero knowledge proofs. We're seeing a lot of innovation on privacy preserving blockchain protocols. And the reason that's interesting is because now we are starting to see DeFi go from just individuals and crypto natives to really institutional users, right? So DeFi is starting to become the new Web3 open internet-based market infrastructure, right? So what will happen is that fintechs, hedge funds, family offices, all of these various types of intermediaries and entities will plug into DeFi, into protocols like Aave and other DeFi protocols to essentially, in a sort of a secure, trustless environment, exchange value on a network, right? So that's sort of this idea of open permissionless Web3 market infrastructure to be used by institutions and individuals and governed by by an open community in a very transparent open source environment is actually fundamentally new, right? So and what that does is one thing we have seen is it's starting to really drive home the future of work, right? So if you look at Aave protocol, we are a very small team. I think now we are by DeFi standards, we are actually big now. We are almost 50 odd people, and but still very small, right? And the liquidity on Aave right now is around $24 billion. So it's a pretty scalable protocol. But what's happening in Aave is that now lots and lots of code and software and innovation is coming not necessarily from the team members of the original team, but they are coming from just about anyone who has a good idea. You don't need a degree to contribute to Aave. You don't need to go to Harvard to contribute to Aave. You can just be anyone with a good idea in anywhere, and that sort of permissionless innovation where anyone with a good idea can actually grow the protocol is kind of something I'm really excited about. And we are seeing things around NFTs, decentralized social media. We're seeing DeFi as just the starting point, and the whole of Web3 commerce, social media, NFTs, and that those spaces really start to take over. Now, that's the one thing that's going to happen. So we are starting. I think what we are seeing is the emergence of a whole new internet, right? And that internet is interesting in the sense that it addresses some of the gaps in what the current internet doesn't have. For example, it does not have a money token. If I want to send money on the internet today, the best I can do is use PayPal and send a transaction which is bootstrapped. So where an email sort of represents I'm sending money, but then the money underlying flows through the traditional banking rails. The other thing we're starting to see is this emergence of decentralized identity, where people are starting to issue DeFi passports, credit histories, on-chain behavior, rewards for good on-chain behavior in the real world. So this type of internet where you have this idea of digital money and digital identity baked in and digital reputation baked in, but while preserving privacy, I think it is fundamentally fixing some of the issues that I think Mark Andreessen wanted to fix back in 1995. So I'm really excited about that, and I was still around in 95, and I'm starting to see that happen finally.
So it does sound though like a lot of some of these DeFi concepts are kind of at odds with established governments or kind of some of these larger regulatory type entities. How do you kind of see this kind of like friction evolving over time?
Yeah, this is not the first time that has happened. I mean, when e-commerce was starting, people were sending credit cards, numbers on the internet, and to buy clothes from. I mean, a person in New Jersey would send their credit card number on the internet to buy a dress from California, and the card number would get stolen, right? And there are lots of so the technology happens first. At that time, there were similar concerns about Web2 or the internet. People used to really worry about, what happens if this falls in the hands of the Russians, and so on and so forth. So I still remember quite a few of those conversations. So there is always fear around anything that's new. So some of the DeFi concepts, the new way of building systems and infrastructure, also obviously create some anxieties. And especially when the technology is still maturing, people tend to obviously have all sorts of concerns, and some people tend to focus quite heavily on the risk aspect. But then I think we also have to think about the opportunity that's coming, and that there are going to be policymakers and governments that start to see the opportunity. and will really get ahead. And that's kind of how Bill Clinton and Al Gore created the do no harm law, or rather created this do no harm philosophy. And I think we're going to start to see some of that again. And the technology will mature. We're seeing an extraordinary amount of investment from both Web 2 and Web 3 players. So technology practices, talent is coming in. So technology happens first, it creates markets, and then lawmakers, policymakers, regulators obviously have to respond to that. So it's a process of synthesis, right? It's obviously there'll be some negative reactions, there'll be some positive reactions, but I don't think you can you get to put this genie back in the box, right? I think the cat is out of the bag now, and people have to really get on with the program.
Which of the governments are you identifying or noticing, are kind of leading the way or kind of on the cutting edge of this, as opposed to those that maybe are laggards and taking, a much slower approach to adoption?
Oh, that's a slightly hard question. I don't want to point any names on that question. but I can tell you that I and Sani and our general counsel Rebecca speak to quite a few policymakers and regulators and agencies from around the world, and obviously they have a fair concern around some of the risks. Of any new technology, when you create jumbo jets and when you're trying to fly, obviously there are some accidents, and obviously people want to risk manage that. There are also, there is always a negative reaction in people who are very steeped in the current ways and very invested in the current architecture, especially people who are not from this digital technology savvy generation, who kind of really didn't smell the coffee while the internet was happening. So we always get various types of reactions, but I would say that in every major Western government we have spoken to, or policy institutions we have spoken to, there is a lot of excitement about the potential of this whole Web3 space. And I think that the key issue is, the crypto community as a whole hasn't really spent enough time or money or energy in education, right? So we've been on our own little corner, and we've grown to 2 trillion market cap really quickly over the last 2 years. And we haven't had the chance to really build some of the tools and our own little groups or policy advocacy and education groups to really influence policy in a sensible direction. So now I think we're starting to see that with DeFi Education Fund, Blockchain Association, a variety of agencies. Now we have Coinbase, Aave, Uniswap, a variety of other really responsible players in the space, investing more and more in education and for everyone, and that's starting to move the needle. But I think we just need to do more of that. I mean, there's no shortcut to really education and advocacy. We have to inform and educate everyone.
Yeah, that all makes a lot of sense. We're actually about coming up on time. Want to toss it back to you in case you have any thoughts or any topics that we didn't really get a chance to cover today.
Yeah. I think the best way to learn about DeFi is to use it. You could read articles and PowerPoints all day, and it will do absolutely nothing. This is literally like the internet. You can't learn about the internet without actually clicking on a browser and going to, back in the day, hotmail.com. So think of Aave as hotmail.com or Yahoo, and please get a MetaMask wallet, download your MetaMask wallet, open a Coinbase account or some account, and get a few crypto assets in your wallet, and then play with it. You don't need to spend a lot of money or risk any money or anything. It's just go with a sense of playing with some of the major DeFi protocols to really see what's going on, how far we have come in the user experience, security, the whole the feel of the space, and then maybe play some crypto games, buy a couple of NFTs on OpenSea, Mintable or Rarible or something. The most important thing with Web2 was to really click on things, right? If you weren't clicking on things, you missed out. I mean, you never got to the .com. The benefits of the .com era, and or you were too afraid and you sold Amazon too soon, right? So it's the same story with Web3. We are starting to look at a phenomenal re-architecting of the web, and the only way to really get on with the program and benefit from it is to start playing with it. Get your hands dirty and have fun.
And then just on the investing side, I thought what you had mentioned as far as, giving yourself some asymmetrical optionality, right? A portion of your portfolio that's relatively small, the downside is real and known, but also the upside is kind of exponential and a much greater magnitude. So it's almost disproportionate if you can take a long enough high.
It's disproportionate, and you have to think about what you're going to regret more, right? I mean, so I think if you miss out on what's going on right now, then you're going to find it very hard to forgive yourself as a strategist. By the way, just one key input here. So we are launching an institutional friendly product. So we are launching Aave V2 for Aave Arc. The idea of Arc is this bridge between traditional finance and decentralized finance. What Arc does is it creates a marketplace where all the entities, corporates, and institutions are KYC by a regulated intermediary, and they can essentially interact in an environment that they're comfortable with. So Aave Arc is live, and if there is absolutely any interest, please reach out to me, and we'll connect you with the folks who are currently doing onboarding for Arc.
Yeah, sounds great. Ajit, thank you so much for coming on today. We really appreciate you taking the time, and think our listeners really enjoyed all of your insights and expertise. To everyone, to listen to other episodes of The Yield, please visit and subscribe on Apple Podcasts, YouTube, and Spotify. And for any questions on Yieldstreet, please visit www.yieldstreet.com or email us at investments@yieldstreet.com. Thank you so much.
Thank you so much.